Good day, Market Chameleons and everyone joining for the first time. Thanks for coming by and watching the Market Chameleon webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and let's welcome Dimitri Pargamonic to the stage. We'll be talking about understanding option volume. How you doing, D?
Good morning, Will. How are you?
Let me share your screen. And there is the landing page for the Market Chameleon. All right.
So for today, what we'll talk about is looking at the option volume and different ways that we could break it down and get kind of a different perspective of what the trading activity looks like. So let me just show some examples first. We could go to the options volume report. So if we hover over the options and we click on options volume, we come to this report. Let me just close this top part to expand our screen. And oftentimes when we think of the options volume, we kind of think in terms in aggregate, is today's volume, total contracts, unusual, or there's more than typical on an average day. And the starting point could be just the number of contracts traded, right? So if we look at the volume here, we have this toggle where we could look at the option volume by contracts or by dollar value. But let's go to the by contracts. So just looking from left to right in Tesla, there were a total of 1.9 million contracts traded in Tesla. And if we compare it to average daily volume, looking at the last 90 days, it's 2.3 million. So this is a little bit below the average daily volume, right? 1.9 million versus 2.3. And that's one way to look at it because it's just total contracts that traded. However, when we look at option contracts, well, they're not all the same contract, right? There are lots of different option contracts. It's not like a stock where, Tesla, there's one Tesla stock. Options have different expirations, different strikes, different prices. So it's not all the same. And because of that, we could break it down, the volume, in different ways. And one way is to look at the dollar value of the options traded, because we could have 1.9 million contracts traded, but a lot of them could have been low-priced options. There are options that trade for pennies, some trade for 10 cents, some trade for $10. So what is the total dollar value of the options traded? How much money or funds are flown into the options markets is a different way to look at it from that perspective. So I'm just going to toggle and show you what that looks like. So show notional value. I'm going to toggle here. So now we see a little bit of a different story in Tesla. There's $2.46 billion worth of options traded versus average daily of 2.05 billion. So from that perspective, in dollar terms, dollars spent on transactions, it's a little bit higher than your average daily, right? And think of it kind of like this, where you could have a stock that's increasing in price, right? So let's say we have a stock that starts at $100, keeps going up to 110, 120, 130, 140, 150. Even if on an average, let's say on every day, every single day, we have exactly 1 million shares that traded. Okay, so the stock's 100, we have 1 million shares of traded in that stock. The stock goes to 110, we have 1 million shares. It goes to 120, we still have traded 1 million shares. But there is a difference there because the share prices are increasing, so the dollar flow is increasing, right? The amount of dollar value is still increasing, even though the number of contracts stays the same, right? So for you to buy 100 shares of stock, let's say you bought 100 shares of stock every day, you'd have to come up with more and more money as the stock's going up, because the stock price is higher. So the idea there is translating it to how much dollar value or flow is going into those option contracts, not just the number or volume of contracts, but the dollar amount that's flowing in there. So that's the idea behind dollar notional, right? What is the total dollar amount that's being transacted in volume? So that's the difference between volume and notional dollar value of all those trades. Okay, so another way then to look at the volume is converting the options to their sensitivities to the impact of the stock price. Okay, so let's maybe we'll go to an SPY options chain just to kind of view it on an options chain. It might be easier to demonstrate that. So I typed in SPY. On the left-hand side, we're going to click on options and option chain. And I'm going to just close this menu to minimize it, expand our option chain. And on the left-hand side here, you see these different option expirations to select from. So you could see that all these options are not all the same. They have different expirations, and we see different strikes here. So we talked about like the dollar value of the strikes, the volume, and let's take a look at an example of a delta, what we mean. So I'm going to just go out here a little bit, November 12th. And on this on this right-hand side, we have calls on the left-hand side, puts on the right-hand side. These are the strikes, and these are the deltas of the options for the calls, the deltas of the options for the puts. So what the delta means here is, let's just take the 685 strike call, right? If we go all the way here and we see that the delta of this option is 27, which means that the option price is expected to change by 27 cents for a dollar move in the stock price. So if the stock price goes up $1 and everything else remains the same, implied volatility stays the same, there's no the option didn't decay. Like if the stock just went up right now by $1, and because by the end of the day or tomorrow there'll be decay, but let's just say it goes up $1 right now, then and implied volatility stays the same, all the other factors remain the same. That's the only change, is that the stock price went up $1. Then this option is expected to gain 27 cents. If the stock goes down $1, this option will lose 27 cents. So that's the risk, the directional risk of this option in the next dollar move. right? That's what the delta is telling us, that the change. So that's important because that's telling us the directional risk of the trade, and that could be different from the dollar value or the amount of contracts, right? Because, for example, here, if we just took the volume alone, right, one contract here on this option, gives you a 27 delta, right? That's your risk, 27 delta. But that doesn't mean the same thing maybe for one contract up here. Let's take the 700 strike. You got one delta, so it'll barely move. This is rounded. It's expected almost not to move at all for dollar change. Okay, so you could have different volume, and you could have a different risk, directional risk for the option that traded. So we could look at it from what kind of like directional risk. In addition, it's not always the delta itself does not always correlate just to the price, right? So we could have, let's go, here's a 27 delta, for price of an option of $1.72. We could find a similar delta. Let's go November 6th. Here's a 31 delta, right? 31 delta for a price of an option of 92 cents, right? So you could, just because there's more dollar value, because the expirations are different, implied volatilities are different, that the dollar value or the volume doesn't translate to unnecessarily bigger or smaller delta. There's lots of factors in it. Okay. But let's say we wanted a 27 delta out further. So look, if we go out further, December 12th, right? To find a 27 delta, we're going all the way out here to a strike of 699. So now we have more days to expiration. So this one still has a sensitivity of 27 cents, but you're at a much higher strike, right? And at a much higher cost of the option, right? So now you could see why we're looking at volume, dollar value, and delta from different perspectives, because this is giving us a different insight on the traded volume, right? Got contracts, but contracts tell us one thing, which is good to know. But we also have the dollar value of the trades, which is telling us something different, because that could, we could have a bigger dollar value traded even with smaller amount of contracts potentially, or vice versa. Then we have the delta volume, where we could have, lots of volume with low delta, right? You could have like a huge amount of volume with low delta options, or we could have less volume but with high delta options, where people are looking at options that have more price sensitivity to the next dollar move in the stock. So that's what the differences are in those metrics measuring trading volume. Well, I'm going to throw back to you now.
Yeah, great job, D. That was another wonderful webinar this Thursday. We'll have one more this week, tomorrow on Friday. Great job, my friend.
Right. Thanks everyone for joining. Stay safe out there, and we hope to see you guys tomorrow.
Thanks again, D. Have a great trading day, my friend.
Yes.
Hey, everyone. Thanks for joining another Market Chameleon live webinar. We will see you again tomorrow on Friday. Remember, if you're following us on any of the social platforms, please thumbs up. Follow us on all of them. And if you're particularly if you're on YouTube, the thumbs up are always helpful. Have a great day, everyone, and trade safe.